Hey, what's going on, guys? This is Hugh with Next Home, and I'm driving right now. So I had a list of some mortgage-related things that I obviously can't see right now because I'm driving. But I'm just gonna list a few terms that you might see during the mortgage process that may be unfamiliar to you. The most common mortgages or the mortgages that we see are conventional mortgages, FHA and VA, and they're totally different. There's different rules, and different qualifications for each of them. For instance, a conventional loan, you have to have 3% down, and you have to have a pretty good credit score in the upper 600s to qualify. Um, it could be a little bit lower, but you would have to have a bunch of money coming to the table, and they have specific debt to income qualifications as well. Um, and then there's FHA. You have to have at least 3.5% down. They have a different debt to income than conventional. And also there's the VA where you don't need anything down. Those are for usually military veterans or active duty, and you don't need anything down. And they also have a different debt to income DTI. Let's see, there's another term that you may hear quite often, and it's traditional mortgages. A traditional mortgage is any 30-year fixed mortgage. That's what a traditional is. And anything else that's not a 30-year fixed mortgage is considered a non-traditional mortgage. So that's your 15-year, your 20-year, 25-year fixed mortgages. Those are all considered non-traditional. And a lot of times, well, I should say almost 100% of the time, the second market, they buy these loans and mortgages from, say you're doing your mortgage with Bank of America or M&T Bank or Empower. Within minutes, hours, there's maybe even a day or so, they're selling it to the second mortgage market, and so that second mortgage market, they have qualifications. So that's why they're so strict. Your bank, like M&T and Bank of America, is so strict because they have to abide by the underwriters for the second market. Mortgage market is like Fannie Mae, Freddie Mac, Ginnie Mac. They have some strict guidelines. So all mortgages, they try to qualify based on their standards and the automated underwriting system that they have, because they want to sell the mortgage that you just bought and spent those 2 months in a contract with. They're going to buy it from them. Okay, so that's why you see the strict guidelines, like you have to have 2 years of employment history, and you have to have a specific debt to income, like 29, between 29% and 41%. And when I say debt to income, what they do is they take your salary or your pay, and it's annual, so they'll take the annual payment and then they'll divide it by 12, so they can figure out the monthly, and then they'll take all your bills that have like a loan or a credit card payment. So they'll take the credit card payment, they'll take the auto loan, they'll take your student loan, and if you have another mortgage, they'll take that, and then they'll divide that to see if you fall between the 29%, 41%, but they want you at like somewhere between 33 and 36%. if we're talking conventional. And the FHA loans, they do the same thing. VA loans, same thing. And what else? The APR, the interest rate and APR, those things are different numbers based on the interest rate. Say you have an interest rate and it's 2.8 and they're showing the APR, which is the annual percentage rate, at 3.0. So all that is, the difference is they're at 2.8 to 3%. The difference is the fees. So the APR is the interest rate and the fees that come annually. So that's what that is, okay? And let's see, what else did we have? Conforming and non-conforming loans. That's pretty much based on Fannie Mae, Freddie Mac, Ginnie Mac. They have to fall for a loan that's conforming. It has to fall within those specific guidelines that the automators for the underwriters had to follow. And the dollar value is so high that you won't even reach it. But if you don't reach that dollar value, the dollar value is like it changes every year. It's like 581,000 or something this year. But if you fall on the other side of that $581,000, that's considered a non-conforming loan. So you still qualify for government or for a loan, but it just has a different title and different qualifications. And I want to go back to debt to income. There are some situations where your debt to income could be a little bit higher, but if it's a little bit higher, usually the underwriter usually asks for additional paperwork so that you could prove to them that your debt to income that was like 45%, there's a reason for it, and you still will be able to pay your bills. And I said earlier that the conventional mortgage has 3% down requirement. So if you were buying a house and the house was $100,000, you're required to bring $3,000 down for a down payment. But there's going to be other fees like closing costs and stuff like that, but that's different. But you are required to bring at least $3,000 to the table if you are doing a $100,000 mortgage loan. And then with that being said, the mortgage company is going to need something else too. And they call that PMI. There's going to be a mortgage insurance because the mortgage company wants to protect their interest, and their interest is you in that house. They want to make sure that you're not going to go default on that mortgage. So they're going to make you pay additional money and buy mortgage insurance. So for conventional, it's PMI, and for like FHA loans, that's what FHA is for that extra insurance. You might pay an extra $50 extra a month for up to 5, 10, 15 years, or maybe even 20 years for the FHA. But if it's conventional, if you get to the 20%, it can come off, and it has to automatically come off at 22%. All right, this is my exit right now. I definitely missed some things on my list, but I'll talk more about it at a different time. If you need anything, message me. This is Hugh Hanks with Next Home. Take care.